We bring you the best only on your radio. Coda Radio. Uncle Bright is live in charge.
Your cracky be ha, or friend Peter. Na or your banking expert. Unipana, your friend no. I am Babidin Comosisiano. He is the head of trading, F.I.C.C, fixed income currencies and commodities. Ecobank. Or friend Peter Dzasa, right? Inti ebe friend na yene na kasaba 1 o'clock. He has a meeting to attend. Inti na quickly no. Yene no emu bosu sisi ana unya kwa no kwa na afi unya ma ene nso. Yemfa mburu ye studio ha. Hello Peter.
Hello. Good afternoon.
Afternoon Peter. Can you hear me?
Yes, loud and clear.
Okay. So we are going to discuss about the free fall of the Cedi, of the currency, that is the Ghanaian currency against the international currencies, being the dollar, the euro, and what we have in trading outside the country. So that's what we are going to discuss. What are the causes of some of this? Can we do mix up with the local language, or we can go straight into English?
I'm more comfortable with English, but I'll try.
Oh,
make it up.
never mind. I also try my best to do a little translation after we're speaking. Let's go straight into the matter. The Cedi is dancing against the international currencies like the dollar and the euro, especially, which most Ghanaian traders trade in. What are the causes of this?
Okay, so I listened to your introduction.
Yeah.
And you did cover a couple of reasons why we have what we have at the moment.
Okay.
The Cedi of is being brought in and how much is being taken out. And the second one is more of the structure or the nature of the economy, right? So if we are only selling and not producing, also has an impact on the strength of our currency. So if I can just broadly speak on the supply-demand side and
Yes.
also the nature of the economy, then we can delve into details.
Okay.
So in Ghana, the supply of foreign currency into our economy is mostly from the exports of our major commodities, gold, cocoa, and oil. Okay. And then non-traditional exports, pineapple, banana, and crafts and stuff. And then we have investments coming in, like FDIs, people coming to invest in companies or put up companies here. And then you also have, you mentioned, portfolio investors.
Yeah.
So people see our Cedi investments as interesting, high yield, 20% for 5 years and stuff. And the foreign investors see it as interesting. So they bring in their dollars, convert it to Cedis, and they invest in our currencies here.
Okay.
And invest in our treasury bills and bonds locally.
Oh, I see.
And aspect which is increasingly important now is remittances, Ghanaians working outside, families transferring funds into the country. Okay. It's a major source of foreign currency into the country. So, and then these days also Bank of Ghana comes onto the market to support Cedi by supplying to importers. These are the major sources of foreign currency onto the market. We'll talk about the impact on all of them as we go along. Still on the demand supply side, the demand side is mostly from imports, right? We virtually import everything into the country, right? So imports of goods and services, that has a major toll, okay, on what we do. And then also the use of cards. If you have a card issued in Ghana, like a Visa card or a debit and credit card, and then you use it outside, it's also a demand for foreign currency on our local, from our local currency.
Oh, okay.
And then there is also the speculative demand. Now, in this speculative demand, when you have in situations where we have high inflation, okay, so the value of your currency is depreciating because of prices going up, people then want to store value in foreign currency. So then there is the demand for the foreign currency, not because you want to do transactions in foreign currency, but because you want to store value in foreign currency. Now, this then accelerates the demand for the foreign currency, which worsens the depreciation. And it is what we are experiencing now, where inflation is at 15.7%. Foreign investors are exiting the country because of one reason or the other, and it has accelerated the demand for foreign currency. Importers who have bills to pay now or even in the future, because Cedi is rapidly depreciating, are bringing the need of their foreign currency now, which is putting much more pressure, okay, on the Cedi depreciation rate. And this is one of the reasons why Cedi is depreciating. And as you already said, obviously there are investors in Ghana. The year has ended. They've done their accounts that has been audited, and they need to repatriate dividends to shareholders. And some of those shareholders are not in the country, so they would need to also buy foreign currency and repatriate. And this also is the demand side, part of the demand side, and part of the reasons why we have pressure on the Cedi. So broadly spoken, in the supply demand side, this is it. The other side is the structure of the economy, right? If you have an economy with high interest rates, okay, it means that the intrinsic value of your currency will depreciate over time because of the high interest rate.
Let
An
me, let,
economy with high inflation also.
yeah, can I come
Okay.
in with a question? I'm
Yes, sure.
interested in this very part, and let me interject with a question. High interest rate, when you go to, I believe where you are, you know that when you go to some African countries, I wouldn't even go outside. When you go to some African countries, the interest rates are cheaper or lower than what is being battered us with in Ghana. What are the main reasons? Because there are some banks elsewhere where the interest rates are very low. They come to Ghana, the interest rates are high. But we know that it is the responsibility of the central bank to regulate and to fix some of these things before the banks can also sell and add their portion to it to the client or the customer. What is blocking us from reducing the interest rate per Bank of Ghana as being an activity? Because I know that the Bank of Ghana is not a commercial bank where they engage in commercial activities, right? It is you who do the retailing of the banking. So you are selling to the public or the clients. Why is it that Bank of Ghana cannot regulate it in such a way that it will be a bit cheaper for you, the banks, to be able to dispense those, what do you call it, rate to the clients?
Okay, so the high interest rate issue is a big issue, okay, which should come first. But in an economy where government is a major player in the capital debt market, okay, where government is ready to issue bonds at high interest rates, okay, you expect that when banks are doing their investment decisions, and if you have an option of giving a loan to a client that have the potential to default for one way or the other and quote unquote risk free to government at a high interest rate, you'll be tempted to place funds with government. So in effect we call it crowding out, where government is borrowing at high interest rates that essentially crowds out the private sector. Okay, so if banks have to lend to the private sector, then the banks will also demand at least what they would get from placing with the bank or higher because of the risk involved in giving monies to individuals and corporates. Bank of Ghana, as you said, has a key role to play in this, and in their way, they try to do interventions. Yesterday, for instance, there was the policy announcement where they announced a couple of things, including increasing the policy rates. The policy rate increase, the idea is to fight inflation as inflation is going up, and by mopping up liquidity on the market. Now, when you raise policy rates, it means that deposit rates will have to be raised by the commercial banks. When deposit rates are raised by the commercial banks, it hopefully will lead to attraction of deposits from into the banking system, and not using those CDs to go and buy foreign currencies.
Okay.
They also make loans expensive to the industry. It means that commercial banks might not push in as much liquidity to industry as it would. So this two-pronged approach of attracting deposits from the system and also not limiting exposures will reduce liquidity, and that reduction in liquidity would hopefully reduce rate of inflation going up, and also the amount of CD available to chase the dollar. So the issue with Bank of Ghana's policy rate is more of transmission, as in when the policy rates are announced, is the intended benefit or intended intervention achieved. In an economy where majority of the population is not banked and a lot of cash is circulating out there, the transmission tends to be limited. But there has to be a starting point. Unfortunately, when Bank of Ghana rates interest rates, it goes to perpetuate the high interest regime. So in the medium term, it's actually expensive, detrimental, but eventually what it does is it stifles liquidity going out and rakes in inflation. Hopefully inflation will come down. Hopefully CD might stabilize and then begin to get the rewards. So Bank of Ghana's tax is actually quite dire. We need to go beyond policy rates announcements and be more of inclusive, and then put in strategies and measures that will bring in liquidity outside the banking system into the financial system. Okay, whether it's through digitization, through making banks available in areas that are not accessible, whichever way it is, so that if Bank of Ghana announces policies, okay, the transmission of those policies are effective, and then it can be realized. And then once government also reduces its borrowing, okay, and government will not borrow at high rates and crowd out the private sector, rates would eventually begin to drop.
Why should government borrow at a very high rate? Is it to compete with the public or the private sector, where individuals and businesses or businessmen also go to the same source to borrow money from? Is it because government want to outwit them by attracting those monies instead of the private sector or the individuals getting those monies, especially investors and those who do who transmit huge sums of dollars or foreign currencies outside the country? Why is it that governments rather tend to borrow higher from the banks, knowing that, for instance, if it is 4.5%, then government comes in and says that I'm offering 5.2%. Then the banks, because you are also interested in profit, you also give it to the the government instead of the individuals. Why is this so?
Okay, so government financing, at every year they read the budget, they tell us their sources of income, and they tell us their plans for the year and how they are going to finance it. So what we've realized is that most of the time there's a financing gap between the revenues that have been mobilized through taxes or other revenue channels and the intended expenditures. Okay, and the gap is what is financed. And to attract funding or financing, you would need to provide attractive interest rates. Okay, so government's intention is not necessarily to crowd out the private sector or the investor. Their intention is to raise funding to implement projects that they have sought out to do. But in raising those financing, they tend to, at the end of the day, borrow or print, issue bonds at quite high rates, which then competes for the same funds that would have gone into financing the private sector. So then, when we have a gap between how much we earn in terms of the government's revenue from taxes or other revenue sources against the government's planned expenditures, that gap is what they finance by borrowing from the markets.
I still have some difficulty with that explanation. Not that we are not explaining it too well, but I still, because I've contacted quite a number of brains and some other people who are experts. They are giving me the same answer, for which I have not been cleared of. So I'm going to repeat. I am saying that government knows that it's going to borrow from the market. Government knows that the banks offer their rate at certain amount, say 4.5. Why should government decide that I want to come into the system by making sure that he borrows, having access to resources or funds? But in terms of doing that, rather they pay higher in terms of the rate. Definitely it will be also transferred to the ordinary borrower who also comes to the same bank. Because I don't think that if you give it to the bank for 5.2, you decide to give it to an individual for 4.5. Is that correct?
Okay, so with time, government have implemented measures and policies to enable it borrow considerably lower or at competitive rates from the market. For instance, when they are issuing treasury bills, there's an auction process where banks put in their bids for how much they want to invest in which tenors. And then government through the central bank sits on it and decide on how much they will take at the rates that investors have put in. So government has in its machinery the ability to say that, okay, where investors have come in at, say, let's say if it's 91-day treasury bills, investors say they will put in their resources at 13.5%. Government has the say to say, no, we will not take at 13.5%, but we will take at 13%, effectively cutting off all those who want to invest at high rates. But government also looks at the need, the gap in financing. And usually when the gap is wide, they are more or less like forced to or compelled to take the investments at those high rates. When you talk about the bond market also, they implemented what we call the bond market specialists, where they appointed some banks to more or less help to raise funding. So this bond market specialists would usually communicate to governments on where the market is, where the appetite of the market is, and then the government will come and say, okay, let's do this or do that. At the end of the day, the objective is as much as possible to raise the needed funding for government at the lowest cost. So to answer your question as to why will government pick up papers at high rates instead of where the market is, they usually will pick at where the market is. Okay, so those high rates are where the market is. That's where the investors are ready to give their money to the government at.
So, is there any solution to some of this continuous fluctuation of the Cedi or depreciation of the Cedi against the major currency? Because it's a major worry. And let me ask this. Why is it that places like the North Africa, Libya, and Morocco and Tunisia, for instance, where their dinar is very strong, is the strongest in Africa? When you look at currency, they have the strongest currencies in Africa in terms of stability. Why is it that, or what happens that they are able to stabilize their currencies strongly as against those of us in the southern part or other part of Africa who are struggling. For instance, if you look at Nigeria, you need over 400 and something naira before you can get a dollar. When you look at South Africa, when you look at other places, same. You need so much. If you look at the Francophone countries, you need so much CFA before you can get $1. But when you go to the North African countries, they still operate like Ghana within a single digit. 2 point something, 3 point something dinar is equals to $1. What do they do different from what we do in our part of the world?
At the beginning, I indicated that our problems is twofold: supply-demand issues, and also the nature or the structure of the economy. Okay, so the solution, really, there are no quick fixes per se in stabilizing the currency, but it has to be a concerted effort at one, the macroeconomic level to ensure macroeconomic stability, and two, the demand supply side, where there's more supply of foreign currency than demand. So if we take, for instance, the structure of the economy, our economy is mostly buy and sell, retail. Okay, when you go to the port is very active. We are doing mostly buying and selling of commodities. Okay, that has a strain on our currency and also doesn't grow the economy. And for the ones that we export, we are mostly a primary goods commodity exporter, okay, and not adding value. So if we don't add value to our produce, what we get out of it is minimal. And then also we need to have an industry base, okay, produce what we need locally, import substitution, rather than depending on imports. If you're able to have industries, structures in place to encourage the building of industries, it starts from the rudimentaries of land tenure system, of power supply, of legislature, of being able to open and operate companies and have information as to be able to do that properly. Okay, these structures have to be in place and encouraged. Okay, you have to encourage entrepreneurship at school level rather than encouraging people to work out of school and going to work. These ones are the structures in the economy. Also, the other one is the appeal of our local goods. Okay, if you give the average Joe between two things, one made in Ghana and one made outside Ghana, there is a high potential that they'll go in for the one made outside Ghana, even if the one made in Ghana is of a better quality. So that mindset also, that things made outside Ghana might be of better quality than things made in Ghana, also has to change. And it can only change when we are also doing more in terms of producing locally and building the skills. Of course, if you are producing locally, things about standardization, okay, standards board, food and drugs board has to be up to the notch. Things about getting the supplies, local inputs, okay. If you are producing locally and you can't get the materials locally, okay, all these are the structure of the economy side. If you are not self-sufficient in what we do, we'll continue to depend on others and eventually have an impact. For instance, the Cedi depreciation. Globally, what is happening now with Ukraine and Russia?
Russia.
Ghana imports, I think last year, we imported about 50% of flour from Russia and about the same amount of fertilizer, okay, from that region. Now, if we don't have access to that anymore, we have to go and buy expensive elsewhere. And the world market for fertilizer, for instance, has gone up. World market prices for wheat has gone up. If we bring that in, the impact is that bread, which has started going up, will continue to go up. Inputs into agriculture will continue to go up. So once we are not producing substitutes for wheat locally, or potash and stuff locally, once we are not finding substitutes locally for our farmers, what that means is that we are bringing importing inflation, okay, because you're going to buy it expensive out there, come and translate it here. And also, once we do that, we have high inflation, and high inflation will lead to devaluation of the currency, which further leads to depreciation of the devaluation in the value of the currency, which in effect is the depreciation of the currency. So the solution really, again, is twofold from where we begin as what the problems are: the structure of the economy and then the demand supply. Demand supply discourage in one way or the other the appetite for foreign goods and encourage initiatives that would produce and utilize things locally and also export. I was having a discussion with my colleague the last time on the value of the cedi itself. Okay, is the cedi overvalued? That's a debatable question. Okay, how do you, if we try to stabilize the cedi, what we are doing is good in terms that we are not translating depreciation of cedi onto the market. What that does is to encourage imports, okay, because imports become cheaper compared to production locally. If an industrialist has to borrow at 20% to manufacture something, his cost of input is high. How does he export that? If cedi is at 10 cedis, okay, it means that when he exports $1, you get 10 cedis. What that means is that he has more value from the exports. And what that also do is that it would eventually discourage the imports. Okay, so the value of the cedi also is it's a question that we have to look at. And we have to answer it by looking at the objective of the country. Is the objective to feed and grow other countries, as in rice farms in Vietnam or whatever it is, or the objective is to develop the rice farms in Ghana? If the objective is to develop the rice farms in Ghana, then initiatives must be put in place to support that rice farm in Ghana and not support the importation of the rice farms from China by supporting the currency. It's controversial, but in the medium term, those initiatives might be hard, might be painful, but eventually it leads to encouraging people to invest locally so that they can export and reap the benefits.
You've taken the thought out of my lips already, because I was going to ask for provision of solution. But from what you've said so far, you've already provided the solutions to it. And because of your time, you have some other meetings to attend. We'll say that we are very grateful for your time and your insight and the enlightenment. You have enlightened us a lot about this. And we'll call you another time. After the show, I'll call you. And then we'll discuss other issues that I think that are very important to also discuss for our listeners to also have the understanding of it. So we are grateful to you. Thank you very much. You hear from me after the show.
Right. Yeah. Thank you. To have a good day.
Thank you. And I'm saying, let me go.